Logan Kelly is a professor of economics at the University of Wisconsin River Falls. His research focuses on the implementation of monetary policy. Logan, thank you so much for taking the time today.
Oh, thank you.
So to start, I've been asking this question. I'd love to hear your thoughts. How much money should exist?
Well, so if we go back to some of the writings of say like Milton Friedman, that the actual the actual amount of money doesn't matter. All right. We could principally work with one US dollar. All right. We just split it up a lot. We'd have a lot of decimal places. Right. Because we'd have to tear that dollar into a lot of little itty bitty pieces. So in one sense, the actual quantity of money, or at least in the absolute sense, how much money there is, really doesn't matter. What does matter, though, is the relative growth rate of money relative to the total volume of transactions throughout the rest of the economy. And in particular, you could think of it as, and this goes back to the old equation of exchange where you have money spent has to equal money received. And so you have money times the velocity of money, where the velocity of money is how many times on average, a dollar is going to change hands in a given period. It's got to equal your price level times your total quantity exchange. So basically, price times real GDP, or nominal GDP is another way of saying that. And so what you want to have is that growth rate of money staying, or maybe putting in a little more simple terms, that amount of money stay relatively constant relative to the amount of goods that are in circulation. So what I mean by that is as the economy grows, we need more money in circulation. Why? If we don't have more money, what will happen is money will become more scarce relative to goods, which pushes its value up, which makes overall price level, the prices of all those goods, right, go down because we're willing to accept less, fewer dollars that are more valuable for the same amount of goods. Likewise, if the amount of money grows faster than the total amount of goods in circulation, right? Total amount of goods, right? We have too much money chasing after too few goods, then it becomes relatively less scarce relative to goods. Its value goes down and we have price level go up, right? So this is kind of the basic, very basic physics of how this works. Now, that's led to, like, for example, the quantity theory of money. All right. Basically just set the growth rate of money roughly equal to the growth rate of real GDP. Well, that doesn't quite get it either because we got all kinds of things making it more complicated. All right. How fast money changes hands changes. It changes due to technology of money, right? Everything from, Venmo to checks to debit cards to uh, what else? Other various examples of Apple Cash. All right, examples of technologies of money that can change how easy it is to transfer funds from one place to another. Um, the other component to that is because actually technology of money is fairly easy to predict. I mean, it's like other technologies. They go in hertz and stirks, but you know, relative to okay, just everyday behavior, it's a little easier to predict. When we talk about people's everyday behavior, you change how you hold money, and that will change how fast or what that velocity of money is on a daily basis based on wanting to avoid opportunity costs. So if interest rates are high, you want to avoid opportunity costs. So you'll keep more money in higher, more interest bearing, less liquid assets versus when we're, afraid of inflation. Um, or we have low interest rates, and then we have opposite kinds of things going on. So there's all kinds of different forces that will cause our behavior to change, that changes that relationship between the growth rate of money and the actual inflation rate. So some of that basic understanding that I started with, we want to keep that growth rate of money relatively constant, or relatively in sync with, that's a better way of saying it, the growth rate of the economy, um, Well, it's in theory that works. In practice, it's a lot harder to do than it's a lot easier to say than it is to do, right? So long way of saying how much money should there exist? Well, roughly speaking, one of the kind of the best way we've come up with right now is to look at the outcome, and that's the price level. Now, there's a couple of different ways we could talk about doing that. You could talk about price level targeting, which is kind of a very edgy thing that's kind of been state of the art for a while, but it's never really been accepted. To something like inflation rate targeting, and all of those get really wonky and really nerdy, and generally, unless you're a monetary economist, you don't care. But roughly speaking, what we're going to do is we're going to look at that overall price level, how it's changing in some way, and we're going to try to regulate that. And we'll just simply attenuate the growth rate of money in order to regulate and achieve that price stability.
So if we're increasing the money supply to kind of, as you described, stay in sync with the growth of the economy, isn't the increase in money supply when the economy grows contributing to the growth of the economy? So it kind of perpetuates that forward whenever you inject money into the system?
So that's a really fun question. All right. So the answer is no. All right. At least I think that's the textbook answer. I don't buy the textbook answer, so I don't care. In any event, you're right. All right. So if I'm, neoclassical, the only thing that matters is unanticipated shocks. Everything else is baked into the cake already. And so anything I do with the money supply, it's nominal. It's not real, so it doesn't matter, right? Well, here's kind of where I come down a little bit differently, because there's short run impacts of monetary policy. When we have a recession, all right, we have a reduction in growth. Now, the thing about it is, when I look at GDP has what we call persistence to it. All right. So if I have a reduction in growth today, I am going to permanently see a lower trajectory for GDP. In other words, if I have a recession today, 40 years from now, GDP is going to be lower than what it would have been had we not had that recession. Right? We basically, the statistical term for it is there's a unit root in real GDP. No, I mean, and that doesn't matter, right? But it's got this persistent shocks tend to be persistent within macroeconomic variables. Okay, so that's the first thing. Good monetary policy that can try to avoid, at least all the recessions that we possibly can. I mean, we're not going to avoid them all. There's some. I mean, like, for example, in 2020 we had a recession that was the result of COVID-19. Okay, that's a non-economic shock. It's absolutely what economists would call exogenous through their models. There's no economic policy we're going to do that's gonna not make that awful, right? So they happen, all right? Natural disasters happen. I mean, it's just bad stuff does happen from time to time. But if we can do monetary policy as well as we can to make the economy as strong as it can at any given point in time, then when you do get sick, all right, you get better faster. So my thought process on this is, yes, for the most part, monetary policy is going to have short run impacts. But those short run impacts do translate into the long run. Why? Because of the persistence we see within macroeconomic variables. The other thing I would say is there are certain factors in monetary policy that I think do contribute to the actual real part of the economy. So in particular, if we talk about risk, so if we have price stability such that basically I can issue a challenge to my class, and for the most part, unless it's an absolute fluke, they're not going to beat it. All right. I want you to beat a 10-year forecast of inflation. We'll just look back in time and we'll pretend, simulate it out of sample kind of thing. Pretend We're trying to forecast 10 years into the future, and beat a guess of 2%, post 1985. And it's going to be really difficult to do that. For one thing, that's the Federal Reserve's target for inflation. So they're actually actively engaging in policy to keep that inflation rate around 2%. And as well as that's just kind of what everybody's expectations are at this point. And so there's a kind of a gravitational force that tries to bring the economy back to that 2%. Well, so we have this target in mind for inflation, right? And so if we do that, we reduce risk, right? You can bank on that. So if I go to the bank and I want to borrow money for a 30-year mortgage, okay, if I have a mortgage rate of 5%, what's my rate going to be? Well, I expect it to be the inflation to be about 2%. So my real rate of return is going to be about 3%. All right. If inflation is going all over the place, what do I have to do as a bank? I have to raise interest rates to be able to account for the possibility of what we call inflation rate risk, right? And so to the degree that we can reduce that risk and that uncertainty, we make it easier for the financial system as non-financial institutions and individuals to invest and invest in long-run projects. And so that's one of the ways I think, yes, good monetary policy done over time. It's a little like exercise, and eating right. If you do all of those things, it's not going to stop you from getting sick. But if you are healthy and in good shape, you've got a better chance at having a good prognosis when you do get sick, right? It's the same thing here. So I guess that's also another long-winded answer to a simple question. Can we improve or increase long-run economic growth through monetary policy? The short run ups and downs, not really. Long run, doing our best to do a good job, absolutely.
Well, so this is one area where I'm curious about the overlap between fiscal and monetary policy. So thinking about like those moments in time where, like when there's a pandemic or an economic downturn and the recession is, somewhat unavoidable. In those moments, our tendency is to provide some sort of fiscal stimulus to overcome those economic downturns. Is that in effect in injecting money into the system just by way of deficit spending, and how does that relate to the monetary policy that follows?
So it depends. All right. It depends on the interplay between monetary and fiscal policy. So first of all, fiscal policy, if we deficit spend, and you have to deficit spend in order to be expansionary, all right, for it to be an expansionary policy, it has to be a deficit spend. Now, it doesn't have to come through borrowing. You could have the money saved up from a previous time and spend out of your rainy day fund. It just so a deficit just means I'm spending more, have more expenses, more going out than the tax revenue coming in. So, I mean, that's the first thing. The second thing is, how do we finance that deficit spending? Well, if we finance that deficit spending by borrowing it from the central bank, in essence, expanding the money supply in order to deficit spend, then yes, that can be quite inflationary. And there's actually times where that may well be the right path to go. For example, when we get in, it's possible to get in something called a trap where our inflation rate is actually so low that we have deflation, and that when we have that deflation, it pushes our real interest rate up. All right, we call this a liquidity trap. And if we push that real interest rate up so high that it starts to retard the economy, then we end up in this spiral where the economy keeps getting slower and slower and slower, causing prices to fall and fall and fall, causing that real interest rate to go up and up and up and up. A lot of economists think that was some of the mechanism that made the Great Depression the Great Depression. And we saw something like that maybe in it's quite possible we saw something like that in Japan during the 90s. And in cases like that, the big problem is the deflation. So what do I want to do? Get the money, basically price stability. I want to bring that negative inflation rate back up to zero. So do something inflationary. So that, I mean, there are times where doing that kind of deficit spending and then borrowing from the central bank in order to pay for that is reasonable. On the other hand, most of the time it's not, and most of the time that's not where most of our deficit is financed. The Federal Reserve may be the single biggest individual debtor for the federal government. It is by no means the majority of the debt, right? They don't hold all of it. There's the general public of the United States, so United States citizens actually as a corpus, as a group, are one of the largest holders of U.S. sovereign debt. So it depends on how we borrow, how we pay for that. So if what we're doing is we're borrowing from anywhere other than the central bank, then it's not necessarily going to be inflationary, at least not from a monetary standpoint. Now, the flip side to that, can we get some inflation out of fiscal policy when we have big amounts of spending? Yes, we can. How does that work, though? It works a little differently than monetary inflation, though, because what's going on is instead of, okay, we've got more dollars chasing after the same amount of goods, and so those dollars become worth less, not worthless, but worth less, right? Instead of that, what we end up with is the government buying goods, right? And crowding others out of the market, right? And let's take, for example, the fiscal response to COVID-19. Did they overjuice the economy? Probably. Did every economist, that was pretty much competent and well-trained and sane say, yeah, this is probably what's going to happen? Yeah. I think there were a lot of us economists who said, yeah, I don't care. This is an emergency situation. Sometimes you take care of the immediate emergency. You've got people dying, right? You've got people who are going to starve, people who are going to no longer have a home, in an environment where, frankly, we don't really want everybody beating down every door trying to find a new job, right? And so that was a very special circumstance. Did it lead to inflation? Yes. But the flip side to that is, if we think about it, that was a fiscal policy that was equivalent to a war effort. All right. The only difference is it was a war on a virus instead of a war on another country. Basically wars are inflationary. Why? Because we have a lot of fiscal spending. And frankly, we do tend to fund a little bit of it by printing money from the central. We don't actually print the money, but by finance it through actions of the central bank. It was, if we look back to World War II, the central bank actually did something called interest rate targeting. They actively intervened in the market to keep the interest rate that the U.S. government had to pay for its debt low.
So the in these examples of like the pandemic and wars, are these situations where we're acknowledging that the current money supply is insufficient to address the societal problem, and is as a second part of that question, is a national debt in any way an indicator of an insufficient money supply?
I kind of want to answer no and no to both of those questions. So let's break it down and take the first question first, where we're talking about, um, we need more money to fight a war, or basically, let's just back it up and say some kind of major national emergency. All right. In general, the problem there is not necessarily macroeconomic in nature or financial in nature. The problem is there's a resource we need that we don't have. So, for example, in World War II, when we entered World War II, we didn't have enough airplanes, ships, guns, and bullets. So we needed to build all of that stuff. All right. We also needed a huge labor force in military. So we had essentially drafting huge numbers of people to go and actually fight the war. So we took several bits of the economy out of the economy and started using them in a different way. So this goes back to this idea of crowding out, right? You saw that in other ways during World War II. You had rationing, right? A comment, one of the advertising jingles that I can I can't personally remember. I'm not quite that old, but that I've always stuck in my mind was if you have a sweet tooth, pull it, right? Because they needed sugar to send abroad to the fighting forces. In any event, so that you have you can have. Why would they want to increase the money supply in that environment? The reason why they'd increase the money supply in that environment is mostly because the government needs to spend a lot because they don't have the resources they need. They need to crowd out that consumption because they need to buy boats and tanks and all of this stuff. And so there you have one form of, well, why was the Federal Reserve doing that? Two reasons. One, to supposedly help the war effort, so that the government could finance all of this spending without necessarily increasing the tax burden, which was actually starting to become quite high relative to what it had been because of the war. But the other reason is they just didn't know any better. You have to remember, in World War II, the Fed actually wasn't that old. I believe the Fed was established in like 1916. So, they were dealing with a lot of things that they were seeing for the very first time. And so the interest rate targeting is really horrible monetary policy. It's so horrible that afterwards the Treasury and the Fed got together and agreed to not do that anymore. But they just didn't know at the time. So those are two kind of reasons they had that there. Fast forward to COVID-19. COVID-19, what did we need? We needed a vaccine. That was immediate or kind of the longer term, win the war kind of thing. Intermediate, like, we need to make sure kids have food to eat, and stuff like that. Well, all right, there was spending, and to be honest, I don't think there was a huge amount of accommodation on the part of the Federal Reserve. But in both cases, we did have significant amounts of, this crowding out. So what happens? Did the money supply change? No. The amount of goods that were available went down. And so what happens? We bid those prices up, and that causes inflation. Same thing happened post World War II. In the late 40s and 50s, you had significant amount of inflation, mostly because there's a lot of pent-up demand from the war period. People had a lot of savings, and they started going out and that were now available again. And well, they put the price up because everybody wanted it. So in any event, I think that maybe brings me around to your second question about national debt, and not necessarily. The biggest thing that we have to be careful of in non-emergencies, because we're talking about over the last 100 some odd years, I've got like three major events, World War I, World War II, and COVID-19 that kind of fall into this big emergency. We need to, we'll worry about macroeconomics later kind of thing. That's not the norm. So those are outlier events. Looking at it more commonly, uh, no, I think the biggest problem we need to do is we need to be vigilant in looking at following a course of price stability with our monetary policy. So that means not accommodating a deficit with lending from the central bank. Um, and the second thing to talk about with that is, fiscal policy, unfortunately, is also, and or fortunately, I don't know how you think about this, it's a political process, and deficits are addictive, right? I mean, because you know, uh, uh, if I raise a voter's taxes, they don't want to vote for me. If I cut a voter's services, they don't want to vote for me. So if I want to reduce deficit, I either have to increase income or decrease expenses or both. Um, and both of those things are quite difficult.
Yeah,
So
you mentioned earlier that I think you were talking about the war, that the part of the reason for the kind of the monetary approach was that they wanted to increase the money available without increasing tax burden. Is that and what you just described with the political problem of the national debt, is it that there will be is it conceivable that there will be more and more cases where we being policymakers or maybe society in general that won't want to increase the tax burden and so will resort to more inflationary monetary policies because of what you just described, like the unwillingness to increase tax burden?
so far, no. All right, at least within U.S. monetary history, so far, or at least history of the Fed. Um, if we go all the way back to Richard Nixon had a meeting with Milton Friedman, and was trying to influence Milton Friedman to say that we needed to have expansionary monetary policy and encourage expansionary monetary policy, basically lower the interest rates. Going into his presidential election, Milton Friedman said, well, that would be a bad idea. Nixon's response was, well, we'll worry about that after the election. And so far, even through that, I think there was some bad monetary policy that went on during the 70s. It's a fun time to study in terms of history, but still, even there, I think they kind of held the line, and remained politically insulated, so insulated from that political process, and really have all the way up through Chairman Powell now. In fact, we've seen President Trump openly criticizing Powell and talking about wanting to get rid of him because he's not doing what Trump wants him to do. And well, I think so far our institutions has come that Trump can't just fire him for no reason. So he's kind of being quiet and living with it. However, Powell's term comes up, and when that comes up, there will likely be a new chair of the Federal Reserve. When that happens, now the chair doesn't control monetary policy. The FOMC, which is made up of the chair, the vice chair, other board of governors members, plus the plus a subset of the presidents of the regional Federal Reserve banks, and that subset changes over time. And so it's not just one person making that decision, but they have a lot of influence.
Hmm.
What happened? I'm really because I've had basically up until now the debate between the debates between who we want to have as Federal Reserve chair have been really esoteric debates that somebody like me is really interested in, but in general, Most people are not. I mean, post 1982, I don't think you're going to find anybody in the Fed who doesn't think price stability is important. Um, the Fed, of course, has a dual mandate: price stability as well as low unemployment, and they want to do both of those at the same time as much as possible. But when the chips are down, we've got to have price stability first. And I think that very much was the switch from the 1970s into the 1980s, and then the 80s are a very transitional decade, but by the 90s, we're really there. We have to have price stability first. Then everything else we want to do to try to steward the economy is next. But first, price stability. And that's really carried through all the way through the current chair. We might disagree on economic school of thought, but fundamentally, everybody has the same intentions, right? They all want the best for the macroeconomy. So will that change when we get a new Fed chair? When Trump gets a chance to change that? I don't know. There's certainly been things to have. The president has given cause for concern that we may not have the most capable person as the next appointee.
Yeah. Well, I want to come back to the national debt for a second. And what you were saying, I'm curious if you think that the national debt, if it's conceivable that we could pay down the national debt in a reasonable amount of time, or if our expectations should really just be to get back to a place where we're running a balanced budget, and then is resolving the national debt just keeping it where it is, or is it paying it off, or is it printing money to deal with it? How do you think about that?
Well, no, I mean, it's not. I mean, the actual, if we look at, amounts of money in circulation have not increased significantly relative to the growth of the economy really in a while. I mean, we have to go back quite a ways to see any kind of issues like that. So in terms of, at least so far, yeah, I mean, we can argue, did Powell keep the interest rate too low for too long and allowed inflation to happen? Well, somebody might argue that, yes. I might argue that, well, we had a huge fiscal stimulus with the COVID relief, and we were going to have some inflation, and sometimes when you've got turbulence, you just ride it out. It does more harm to try to fix it than it does to try to than what the turbulence does. You just deal with it. And a lot of the inflation, I mean, I realize it was high relative to what we've all seen in most of our adult lives. We've gotten very, very used to being a very low inflation country. But it was not particularly high relative to economies across the world. It was not particularly high relative to even U.S. economic history. I wouldn't want us to stay there. So the Fed acted appropriately in taking measures to bring inflation back down. But, in the grand scheme of things, we had a blip where it went up a bit. And then we took corrective policy and it came back down. So I don't fault any of that. Where I do have concern is where we continuously run a budget deficit. So that's ongoing. So basically what we're doing is we're not paying off our credit card and increasing the balance every single month. Well, at some point that does become unsustainable. Where does it become unsustainable? I don't know. I mean, we can argue, when we get to 100% of real GDP. Well, for some countries that might be right. For the US, which has a huge amount of foreign investments, probably not. On top of that, you also have to consider what's the net value or the net worth of the United States? Because yeah, we have debt, but we also have a lot of assets, right? We have aircraft carriers and such. Um, Realizing, of course, that's not a particular, an aircraft carrier is not exactly a liquid asset, but we do have things that stand in the gap for that. Um, but I mean, I'm more concerned about the fact that we don't seem to be able to have the political will to have responsible fiscal policy. I mean, we need to have a tax cut. All right. I don't know why we need to have a tax cut, but we need to have a tax cut because that somehow grows the economy. Although, frankly, both theoretically and I mean, if we just look empirically, that doesn't really seem to be the case. I mean, taxes can be too high. And if taxes are too high, that will slow economic growth. Yes. But taxes can also be too low. And so, but to pay for that, we're going to try to cut Medicaid. This does not seem to make sense in terms of a rational or mature or even responsible fiscal policy. And part of the thing I'd like to see us do is return back to a more responsible fiscal policy. Roughly speaking, yes, a balanced budget, if not a little bit of surplus. If we could run somewhat counter-cyclical so that we run surpluses when we have expansionary periods and deficits when we and do deficit spending when we need to for recessionary periods, that would really be optimal. We could reduce the debt. What's the optimal level of debt for a sovereign debt for there to be? I don't know. The sovereign debt serves, at least particularly the United States, serves a very important function within the U.S. economy as well as the world economy. It is still, I know Moody's downgraded us, but I mean, it's still the default risk-free interest rate. So when I look at U.S. government treasuries, that's still in all of our models, what we're using to model what a risk-free interest rate is. And what we mean by that is default risk. And, our credit history is longer than our current government. We have not defaulted on a loan to the federal government of the United States going back to the Continental Congress. So that's important. Because we have that, there are countries in the world who hold U.S. securities as their reserve asset. Instead of holding gold, they hold U.S. Treasuries securities. Why does China hold so much U.S. debt? Well, because they've had a positive balance of payments because they've been net exporters. They needed someplace to put the money. They needed someplace that was big enough that they're not going to distort that market, and it needs to be fairly safe. Well, when we start adding that up, there ain't that many markets out there. I mean, it's pretty close to the U.S. government sovereign debt, and that's it. The federal government sovereign debt is just about the only market that kind of fits that bill. So it's not even necessarily, in my mind, the best idea to completely eliminate the debt. The thing you got to remember is a nation is not the same as a household. It doesn't operate with the same physics. Now there's things and there are things that are analogous and that port over. Generally speaking, in normal times, you should not spend more than you take in. Right? That ports over. But not everything scales up to a nation the size of the United States.
Yeah. Well, Logan, I really appreciate you taking the time and sharing insights and just entertain my questions. So thank you, and I hope we can continue the conversation down the road.
Sure, anytime.